Hey everyone, today we're going to pull back the curtain on a company's finances. We're going to talk about one simple but really powerful tool that can show you a company's financial health in just a single number.
This is the question that probably keeps a lot of investors up at night. A company can look amazing on the surface, right? Great products, great marketing, but what if there's this hidden mountain of debt that's about to bring the whole thing crashing down? How can you spot that risk before it's too late?
So where do we even begin to figure this out? Well, we start with one fundamental question. How much of this company is actually built on borrowed money? This is, without a doubt, the first and most important check on its stability.
I like to think of debt like a seesaw. A little bit of it, a manageable amount, can actually lift a company up to new heights of growth. But if that weight gets too heavy on one side, it can send your investment plummeting fast. Finding that perfect balance is everything.
Luckily for us, we don't have to guess about this balance. There's a specific metric designed to give us a really clear, instant snapshot, and it's called the debt-to-asset ratio.
So this metric is what they call a solvency ratio. Now that's just a fancy way of asking, can this company actually pay its long-term bills? In really simple terms, it just tells us what percentage of a company's stuff, its assets, is actually paid for with borrowed money. And you know what the best part is? The math is incredibly simple. Seriously, you just take the company's total debt, all of it, and divide it by its total assets. That's it. No complicated formulas, just one little division that tells a huge story.
Okay, so that's the theory. But let's actually put this tool to work, right? We'll start by looking at a company that's in a really strong, financially healthy position.
All right, let's meet Company A. As you can see, it has 10 crore in debt, but it owns 40 crore worth of assets. Things like factories, cash in the bank, equipment, the whole shebang. Now let's run the numbers.
Okay, so 10 divided by 40. That gives us 0.25. It's a simple number, sure, but what is it actually telling us about this business? Well, a ratio of 0.25 means that only a quarter, just 25%, of the company's assets are funded by loans. The other 75%, the huge majority, is owned outright. That's their own money, their equity.
And this, right here, shows the company's real strength. Think about it. If some crisis hit, they could sell off just a quarter of their stuff, pay back every single loan they have, and still have a massive, totally debt-free business left over. Now that is a fantastic safety net for an investor.
But what happens when the numbers aren't so healthy? Let's switch gears and look at a scenario where the red flags start to pop up and the story gets a whole lot darker.
Okay, now let's look at Company B. It also has 10 crore in debt, but here's the difference. It only has 10 crore in assets. The numbers are perfectly balanced. Now that might sound okay at first, but in finance, that's like walking a tightrope with no safety net.
The math is as simple as it gets. 10 divided by 10 gives us a ratio of exactly 1.0. This one little number signals a massive shift into way, way riskier territory.
A ratio of 1.0 means that 100% of the company's assets are financed by debt. Everything. Every building, every machine, every last piece of inventory, it's all funded by lenders. There's zero cushion, no owner's equity. This company is walking on a razor's edge. And finally, here's our most alarming case. Meet Company C. It has that same 10 crore in debt, but it only owns 5 crore in assets. The debt is now literally double the value of everything the company has.
The math here is pretty stark. 10 divided by 5 gives us a ratio of 2.0. And let me tell you, this isn't just a red flag. This is a full-blown, blaring alarm for any investor.
So here's the bottom line. Even if Company C sold absolutely everything it owns, it still couldn't pay back its loans. It would be left with 5 crore of debt and no business to even speak of. This company is what we call insolvent, and bankruptcy is a very, very real threat.
Seeing them all side by side like this makes the story crystal clear, doesn't it? You've got the safety of Company A at 0.25, the high wire act of Company B at 1.0, and then the absolute free fall of Company C at 2.0. This one chart tells you pretty much everything you need to know about the risk of each investment, all at a glance.
So we've seen the good, the risky, and the downright dangerous. So what does this all mean for you? How do you apply this? Let's boil it all down to the essential rules you can actually use as an investor. Okay, here are your rules of thumb.
Generally, a ratio under 0.5 is considered pretty healthy and conservative. A ratio of 1.0, like we saw, is risky, and anything above 1.0 is a serious warning sign. But this last point is absolutely critical. You have to compare companies within the same industry. What's normal for, say, a bank is going to be totally different from a software company. Context is key.
And one final really important point. Debt is not inherently evil. Smart companies use debt as fuel for growth. I mean, if they can borrow money at 5% interest and use that money to generate a 15% profit, well, taking on that debt is a brilliant strategy. So remember, this ratio is an amazing starting point, but it's not the final word.
So now you have it, a simple, powerful tool to look past the flashy headlines and check a company's financial foundation for yourself. So go ahead, try it out. The only question left is, which company are you going to check first?